Good day to one and all. This is Dr. Sivaraman of iknowindices.com. Today I'll be presenting the webinar, Tracking the Forex Market Together in two parts. Part 1 is between 9 and 9:45 GMT on 30th of March, the quarter ending and the month end time. And part 2 between 13 and 13:45 GMT. So in two parts, I'll explain the simple market tracking technique and also effective trading strategies, how to handle the positions effectively without taking much of a risk from that of the market. Thereby, we'll be able to earn consistently from the market. Hope you're able to hear me properly. Good afternoon to one and all. So to track the market, we use the live market code page as the tool. So the link is displayed here. I'll also display the link in the .com window. You'll be able to see the link. I'll also focus the camera over that of the link. Now this is the link. We'll be using it in order to see the live market in course, and current time is 9:01 GMT. So the timing is given in GMT. Besides, you come across against the four majors, Euro, GBP, USD Yen and USD CHF, and also the two commodity pairs, USD CAD and Australian dollar. You come across the bid and the ask. The spread is shown as 2 pips, 1 pips, etc. Then also you come across the high, low, and the net change from that of the previous day close. So this is the only tool we use and not the charts or any of the statistical calculations as a simple market tracking technique. So in this simple market tracking technique, I'll explain step by step. We identify in terms of GMT the session timings. So the session timings followed by that of the players are being noted down, and they have been consistently using it for several years, and these are the current timings. The Japanese session starts from 0030 GMT on each day and gets over by 7 GMT after the daylight saving system is switched on in Europe as well as US. Then the European session starts from 7:30 GMT and lasts till 13 GMT. In between, you come across 30 minutes time frame, which is referred as a gap time, and during which the banks in the Asian region gets over and they stop the trading, and the European session or the European banks commence the trading from their local time 9:30 GMT, 9:30 local time. So you come across there is a gap in terms of the GMT time frame, and this is referred as a gap time, during which the bulk orders of the exporters and the importers and also the currency conversion trades in bulk volume may not happen in the market. And that time is being used by the other players to make stop-ins. So the gap time moves are false moves, and you'll be noticing on a daily basis they try to make a false move before that of the session starts. So European session nowadays starts from 7:30 GMT and lasts till 13 GMT. Similarly, another gap time is there between European and US session, and that gap time is from 13 to 13:30 GMT. So today I'll be presenting part 2 of the webinar, Tracking the Forex Market Together, between 13 and 13:45 GMT. So gap time and 15 minutes of the US session. So there again, I'll explain to you how the gap time can be used for small swing trades. And now we are in the mid-European session. European session started from 7:30 GMT and 9 GMT we are in, and it is the start of the mid-session. Then US session is from 13:30 to 20:30 GMT. After that, you come across from 20:30 to next day 0030 GMT is a gap time of about 4 hours. And during that time, again, they make the false move and try to hit the stops of the traders. So if you identify the market timing and develop your trading strategies, depending upon the time frame followed by that of the big players, you'll be able to really understand when they are going to make big moves. So from the start of the session, up to 1.5 hours is the early session. Similarly, 1.5 hours towards close of the session is the late session. In between is the mid session. So from 7:30 to 9 GMT, they handle the majors. Afterwards, they handle the crosses because they need to handle the majors as well as the crosses alternatively in a given day so that the swings will happen in all the currency pairs, including the major commodity pairs, crosses, etc. Then the last 1.5 hours from 11:30 to 13 GMT is the late session. Again, they will come back to that of the majors in order to make the opposite move of what they had done it earlier so that they'll be able to trap the traders. So on a daily basis, they try to handle the majors during that of the session start or the early session and the late session time, and mid sessions they handle the crosses. Similarly, during that of the US session. So that we need to understand. Then we come to the question of how to track the market using the live market quote page as an exclusive tool for trading without using any other type of analysis. So once you open the live market quote page, LMQ is live market quote page. Once you open it, you try to note down the high, low, and the net changes in 4 majors and 2 commodity pairs around 3:30 GMT. So between 2:30 and 3:30 GMT, they try to set the low and the high in a 1 hour time frame. And many will be asking the questions, why you prefer to choose this 3:30 GMT? It is not my preference. It is the preference of that of the players. So the players set the 2:30 and 3:30 GMT, the initial low and the high, and that is used effectively for their communication strategies. So beyond that, I will not be able to explain it in a public forum because already we come across, they are aware that I am disclosing it to the traders. So the initial low and the high are being set around 3:30 GMT. We can make a note from that of the live market quote page, the initial low and the high. So I'll just focus the camera over there of the live market quote page again to show where exactly the initial lows and the highs. So you come across the high here, and this high you can make a note of it around 3:30 GMT. But now it is 9 GMT. It will be varying from that of 3:30 GMT, what has been noted down. And similarly, the low is also noted down around 3:30 GMT. And also you can make a note of the net change, whether it is in the negative condition. If it is negative net change, then it will be in red. If it is positive net change, it will be in green. So you can understand that where the current market is. For example, euro, when it is showing 37 pips positive net change, it indicates that from yesterday US session close, euro has gained about 40 pips. So that means yesterday's US session close rate was 1.3301. Then 40 pips added to it, it becomes 1.3341. So this is how the net change indicates. And also there is a restrictions with regard to the market moves. They can rise or drop about 150 pips in the case of euro in most of the days. So they already gained about 100 pips. If at all, if they want to gain, they can gain only another 110 pips on a normal day. And in case if they want to drop, they can drop about 190 pips. 150 plus 40 pips they can just lose. So 190 pips they can drop it. So this is how they try to make intraday moves between sessions and also during the day, so that we need to identify whether they are going to drop the market or rise the market. That is very important. So now let us analyze what are the initial lows and the highs set for today. Thereby we will be able to understand where exactly they are making the current moves. So after noting down the initial lows and the highs, the net change indicates the current market level from the previous day US session close. That's what I explained. Then watch the market whether it is near the high or near the low. If it is in the middle level, simply relax, don't initiate any trading. When they come closer to low, you just observe whether they are trying to breach the low or just making a move up to that of the low before making a reversal, or up to that of the high and trying to make the reversal. And as I explained, the majors are active during that of the early and the late sessions. The crosses are active during that of the mid sessions. So we have to identify what sort of moves they are trying to make it. So before that, we need to know what are the initial lows and the highs they are set for today to identify the type of moves. So let me focus the camera over that of the initial low and the highs noted down today. Today is Friday, and in the live market code page you can see that initial low was 1.3294. Still it is not been breached. In the current live market code page you can see 3294 is still the low, whereas the high has been breached. 3355 was the initial high. They went up to 3375, another 20 pips above, and currently has come down below that of 3355. So that means during this late Japanese session and the early European session, they made an upward stop and move and come below that of the initial high. And now currently they are trading in the middle level between the low and the high, not breaching the low, not breaching the high again during the mid session. In the case of GBP, 59.48 is the low that is not being changed, and only the high they breached, 59.82 was the high, and they breached and went up to 1.6033 and came down to 59.82, the high. So after 2 hours also they are holding above that of the initial high. When they just make an upward stop and come below that of the initial low, then it is referred as a stop in less than 30 minutes, that type of move. Whereas in case if they just breach the high and go above and form a new high and stay above the initial high for more than 30 minutes, then there is a possibility that they can hold above that of the initial high for 2 hours and continue cutting the new high every 30 minutes. Then that is referred as an extended move. In case if they just continue to breach the new high after 2 hours, that means for 2 sessions they wanted to make an upward move, and that is the intentional move. They continue to breach the new high after 2 hours, then they continue to breach it every 30 minutes to 1 hour, the new high, and continue to gain the levels. And also you can confirm it when they are making slow gains. When they make a quick gain, then it is a false move. And normally during the extended move, they make a quick move, whereas during that of the intentional move, they make a slow gain and swings. Now GBP has also come below that of the initial high, 59.82. So in the case of GBP, they just made an extended move above that of the high and come below after 2 hours. So this is how we try to identify what could be the next move. I'll explain to you. Then in the case of yen, 81.94 is the low that has been breached and formed 81.84 as a new low. 82.50 was the high, and that has not been breached. So in the case of yen, they just breached the low as a USD weakening move. So in the case of euro and GBP also, they have done the USD weakening move and they are showing positive net change, euro and GBP. Yen is showing negative net change. In the live market code page, you can understand that they are making the USD weakening move. In the case of Swiss franc, 90.27 is the low they breached and formed 0.9009, breached it by about 18 pips, and the high was 90.68. That is not been breached. And if you see the net change in the case of USD CHF, it is showing 24 pips, whereas euro positive net change is about 27 pips. So euro positive gain is more when compared to that of the negative net change in the case of CHF. So they do not want to drop more USD CHF. They are just only making a small dip when they are making good rise in the case of euro. Then in the case of Canadian dollar, 99.53 is the low that is not being breached. 99.84 is the high that is also not breached. And in the case of Australian dollar, 1.0367 is the low, which has not been breached. 1.0398 is the high, was the high. They breached the high and formed 1.0416 as the new high and come below that of 1.0398 now. So that means they have made an upward open. So now let me go back to that of the other PowerPoint presentation, explain to you the type of moves, how to understand them. So I showed it in the case of Euro, a stop and move, which has happened in less than 30 minutes. Go above that of the initial high or initial low. In the case of Euro today, they have gone above that of the high and gain about 15 to 25 pips. Sometimes even 1 or 2 pips also happen when the volume is less, and then reverse the market in less than 30 minutes. A false move is a one. They go up to that of the initial high and reverse it, or up to that of the low and reverse it. That is a false move without breaching the low or the initial low or the high. So that is also a move happens in less than 30 minutes. Normally what they do is the false move, they make it before an extended move. What is extended move? This move is more than 30 minutes and up to 2 hours. So the extended move, they go above that of the high and stay above there for more than 30 minutes, like what they have done in the case of GBP. And then subsequently, after 2 hours, they start breaching the new high and come down. So that is an extended move. After an extended move, they can just do the intentional move or a false move again and then continue the extended move in the form of intentional move. So I'll explain it one by one what they are trying to do it today. So first of all, you try to identify how the moves, first of all, understand how to identify the type of moves. So less than 30 minutes stop and then false move. Then more than 30 minutes up to 2 hours is extended move, and these extended moves are quick moves, whereas intentional moves are slow moves, and that happens for more than 2 hours and last up to 2 sessions and reverse during that of the 3rd session. So intentional move, go above that of the high or below that of the low and continue to cut the new low or the new high more frequently beyond 2 hours and up to 2 sessions and reverse during the early part of 3rd sessions. So during the early part of 3rd session, they pretend as if they are going to drop and suddenly reverse it. That is referred as the intentional move. After the intentional move, they always make an extended move. So they always make these moves in sequence. So in between you come across a false move or a stop and. So before the extended move, they can make a false move mostly. And before the intentional move, they make the stop-ins. So this is the general scenario. At times, they do make stop-ins before the extended move, especially during that of the data release time, etc. So when there is a data going to be released around 12:30 GMT, then up to 12:30, they could make a drop in the case of Euro and make a false move up to that of the low or breach the low and just reverse after the data release and go up. So they make false moves during such data release time and also during that of the gap time, what I have shown it in the market timing of the different sessions. So intentional move is their true intention and they wanted to gain the levels. That means they wanted to gain slowly the levels day by day. As you see in the case of Euro and GBP, on a daily basis, they are slowly gaining the levels, but it will appear predominantly as if it is going to fall. Why they are pretending like that? So that the traders will initiate sell and buy trade. Once the traders initiate sell and buy trade, when the players quickly gain the levels during the weekend, and all the short sellers will come for short covering. Normally what happens when the market goes in a range and suddenly if they just widen the range on the upside as well as on the downside, you would have seen on Wednesday that they made an upward stop and above that of the high and a down up and below that of the low. And yesterday they dropped further down. In the case of Euro and GBP, pretended as if it is going to drop further downward. So that those who are holding long positions from that of the higher level, they liquidate out of fear that the market could correct further down. Then later on, they gain the levels on the last day They know very well that traders liquidate the long positions and turn short in order to earn back what they are last holding a long position. They wanted to earn it by taking a reversal trade, do a sell and buy trade, so that they'll be able to compensate the losses. But after taking the sell position, the players gain the levels and induce them to do the short covering. So if the traders alternatively become bullish and bearish and try to follow the market sentiment and try to take positions accordingly, invariably you come across such traders are vulnerably trapped by that of the players. So reading the market is one, and later on trading strategy is other. So one might be a very good forecaster but need not be a good trader. A person might be a very good trader and he won't be bothering about the forecast at all. So ultimately what is more important as long as trading is concerned is the trading strategy. It is not the forecast, the ability which is going to give the money for that of the traders. It is the question of how effectively you control your risk and maximize the profit. So there comes that importance of the emotions, especially the psychological conditions of that of the traders. So if the traders have got a bad experience of making continuous stop loss or the stops are being triggered, then they invariably see that if usable margin gets reduced, then automatically they develop the fear, and that is referred as the market fear. Once the market fear grips in, invariably our emotions control the brain. The common sense of the brain and common thinking ability of the brain is being shaken by that of the emotions. It is nothing but our internal body reactions, and our emotions are triggered by that of the endocrine glands, and there is a system called neurohormonal balance in the body. The neural system, the brain, and the hormonal system, they coordinate with each other. Whenever it is required, the neural hormonal system is triggered by the brain, then the hormones are added. They are secreted by the ductless glands and they are added to that of the blood. As a result, you find the body reactions are being expressed in the form of emotions. And most of the emotions are short-lived. And when you get angry, within 30 minutes, you just get subsided. And similarly, if you start crying, you cannot cry for several hours. You may intensively cry for 30 minutes afterwards. You will find the crying comes down and the tears may not fall afterwards. So normally these emotions are being triggered in such a way and they are short-lived. But the players know very well such emotions are being triggered by surprise. So what the players do is they make a very quick move in the market and it gives the surprise. When you anticipate euro to drop, when euro goes up very quickly, then immediately it gives the surprise. When the surprise is given to the brain and it triggers without its knowledge the endocrine system, and as a result you find the hormones secreted in the blood and you become excited or you become frightful and you try to do distress trades. Just do the short covering in order to protect the usable margin and later on see that you are the one who bought it at the highest level. Afterwards the market started falling freely. So this is what happens in a market when the traders are under the grip of emotions and they try to go in for crisis management. Instead, if you want to avoid crisis management in order to protect the equity, the best way is plan that the market can go against me at any given time. When the market is capable of going against me anytime, irrespective of the type of market study what I have done it, so then you have to use the trading strategy. So use the hedging. In case the hedging facility in the same pair is not available, you can choose a currency pair. Say for example, euro, you are taking a buy position and you want to hedge it. Wherever euro is in the numerator in a cross, you can choose it for hedging purpose. But also see that the net change in the case of euro currently is about 36 pips. Then you try to choose the currency in which euro is in the numerator, where you come across almost to that of 30 to 35 pips or 36 pips net change is seen. In such a currency pair, you try to keep the entry stop or the sell order below that of the market. So that will limit your risk. So in case euro drops suddenly and it is a numerator, we know very well mid-session they just handle the crosses for that they make such drop. And immediately your euro CHF or euro yen position might be triggered, then you will be having a sell position which will be making profit, your buy position will be making loss. As a result, you will find that your usable margin does not get eroded more than that. So once I take an entry, say for example I am buying euro at 1.3340, then I am keeping 30 pips below the current market condition in the case of euro yen. So in the case of euro yen, when is currently euro yen is around 109.48, then I try to keep 30 pips below the hedging order. And in case if I choose the crosses, the spread in the case of crosses is much wider compared to that of the majors, then ideally I can keep 50 pips hedging order, that means sell order below that of the market. So my hedging order will be around 108.98 in the case of euro yen. That way you can use as the entry stop or the hedging order. In case you do not want to do it, at least use a stop to limit the risk. And once it is stopped out, you can re-enter into the market at a much better level. Ultimately, you will be able to earn at the end of the day if you effectively follow this system. If you lose your mind and try to turn opposite and try to do the trades in a distressed way, then you come across that the market punish either side of its moves. That is why I always say that the market rewards patience rather than that of the impulsiveness. So if you want to control your emotions, if you use the hedging order, then you know very well when the market goes against me, I am protected. I will only block 30 pips. I will not block unlimited money. So when you have that mindset, then the market fear does not come in. Once it is hedged, then I'll explain to you how to handle it. So our entry is 30 minutes of watch from the start of the session, and you identify whether they are making a stop end or they are making a false move or they are making an extended move or the intentional move, ultimately using the initial lows and the highs. So after the extended move or intentional move, when the new low or new high is not being breached, in this case we identified it is an extended move, then after 2 hours you try to take sell near that of the high when the new high has not been breached in the last 30 minutes of your observation in 2 hours time frame. Or if you are watching it and you identify that they continue to breach the high after 2 hours, wait for the third session starting time. They will make one upward stop and then reverse the market. During such upward stop you try to take the sell near that of the new high when it is not breached. So you have to identify the type of moves, then your entry becomes very, very simple. Then similarly, when I take in a buy position near that of the low, my exit will be near that of the high, that profit taking. And once the position makes about 25 pips profit, keep stop at the entry and remove the hedging order and make it as a trailing stop, so that your profit, minimum profit is protected by that of the trailing stop, and a maximum profit could be achieved by that of the limit which is closer to that of the high, in case if it is a buy and sell trade. In case if it is a sell and buy trade, the buy limit will be closer to that of the low. And you can move the limit order away from the market to maximize the profit when the trailing stop is not being hit. Thereby you will be able to achieve about 100 to 150 pips profit, and you will not blindly look for the profit. Similar to that of the market fear, you come across another emotional condition, namely the greed. So once the position is making profit, immediately you take a decision, okay, let me take about 300 pips profit because market has just breached all the resistance and it is going up straight away. Why should I book profit in a hurry? So You just simply watch it. They might make further rise, but when all the traders turn long after breaching all the resistance and the market has gone up, then the players are not fools to give them profit. So they try to drop the market in a matter of about 30 minutes or 1 hour when the traders are all turned long using some sort of trigger. It might be a USD positive data or a negative data. They can simply give an interpretation, and it has to, US dollar has to strengthen or US dollar has to weaken, they can say, or they can simply say that it is a risk appetite move on the upside in the case of euro going up, or it is a risk aversion move, the euro going down. So they can give any sort of interpretation and reverse the market. In case if you don't have a trailing stop, the position might be making loss. So there are many traders who, when the going is good, they don't capture the profit. And that again is out of emotions. So we are not giving any chance for the emotions to take decisions. Instead, we plan ourselves, then keep the trailing stop. When the market goes up, to make an upward stop, and before making a reverse, the trailing stop will quickly run and close the position at the highest point, closer to the highest point. And you will be able to see that really you are making very good profit out of such trades. So ultimately, if the hedging is filled, you need to understand how to handle the hedging. So you are keeping 30 pips hedging order. In case if they are just filling it, then watch calmly for minimum of 10 minutes and a maximum of 30 minutes and take action against the hedging. Unless and otherwise, you are capable of reading the market, what could happen tomorrow or day after tomorrow. And there I am using my forecast. Other than that, intraday trading is being done by that of the market reading. So 10 to 30 minutes you wait if it is hedged. Then if the hedging is making loss, you refer the market only pertaining to that of the hedging, not the original position. The hedging is making loss consistently for 10 to 30 minutes. Then close the hedging with 5 or 10 pips loss and keep another hedging order 30 pips below the market if it is a buy position, or above that of the market if it is a sell position, and try to move it to that of the original level and try to keep stop at the entry and remove the hedging order. Until such time you are able to keep stop at entry in the original position, you continue to trail the hedging order and see that you are taking a minimal risk. In case if it is hedged second time, review it again for 10 to 30 minutes. Then again close it and keep another hedging order. If it is hedged second time, give a time gap of 2 hours because your position is hedged again because they are trying to do the extended move. You have failed to read that extended move. Give time for 2 hours, and after 2 hours you try to unhedge. In case they fill the hedging after the 2 hours, understand you failed to read that it is an intentional move. Don't close the hedging. You keep stop at entry in the hedging. They will be showing profit in the hedging. Then once they stop cutting the new low for 30 minutes to 2 hours and confirm that it is a third session they wanted to reverse, at that time you can close the hedging to do the either way trading, book profit on the hedging and keep 30 pips below another hedging order and trail it upward when they start moving the next day on the upside. In case if it is hedged, continuously making profit, keep stop at entry in the hedging and wait for the market to reverse. Let it take 1 or 2 days and reverse. Then you continue trading on the upside. So these are all the possibilities. There are other strategies also, but try to understand basic strategy. Then you can think of the other type of trading strategies using hedging. So I explained to you how the positions are to be taken, looking into that the market moves, and later on try to exit out of the position with profit. So I have given a table here. First of all, we will choose the currency wherein you come across more than 40 pips the spread is seen between the low and the high. Let me go back to that of the live market code page. Okay. I'm just going to restrict only to that of the majors because time constraint is there. It's already 9:35 GMT. Euro is currently trading around 33.39. It is a mid-level, and low is 32.94, and the high was 33.75, and initial high was 33.55. It is holding it below that. Still, as for the forecast, they are expected to gain the levels. They made an extended upward move. They are handling the crosses during mid-session. Afterwards, they are expected to gain the levels. How you identify that they are handling the crosses? Also, when they make contrarian move, you will be able to identify where they are making the contrarian move now. Euro is showing USD weakening move. Yen is showing USD weakening move. GBP is showing USD weakening move. Then CHF is showing USD weakening move. The majors are showing USD weakening move. Come to that of the commodity pairs. USD CAD is showing the USD gaining move, and Australian dollar is showing USD weakening move. It is a contrarian move. Whenever they make the contrarian move, understand that they are handling the cross. And mainly they are handling the Aussie Canadian dollar cross. For that they are trying to make the moves of that nature. Now it has come to -1 pip. So you can identify what they are trying to do it. As you know that they are handling the crosses now, it is not ideal time to take position. But just to show how exactly the positions can be taken, because it is not session start time, still I'll try to take a position and try to show how exactly I'm handling the trade. So Euro is currently trading around 33.40.41, and the high is 33.75, the low is 32.694, and since I have the hedging facility, I can just take the position that spread is more than 40 pips. And here again, in the case of Yen, spread is more than 40 pips. And in the case of GBP also more than 40. Everywhere you come across more than 40 pips. So we can go back. I'll go back to that other PowerPoint presentation and mention the currency pair. Now I'll try to take the Euro position. Okay. So when currently market is 33.43, I'll try to keep 10 pips below an entry order. 10 pips below, I am keeping an entry order. Exit, I'm not going to keep it. I'll keep an entry stop or the hedging order 30 pips below market, 1.3303. Okay, 1.3303. So 30 pips below that of the market, I am keeping a limit order 1.3333. When market is around 3343, 10 pips below the market, I am trying to keep a limit buy order. So this is a buy order. And this will be sell entry stop order. Hope you are able to understand. Sell entry stop order. And once it is filled, then I'll try to watch the entry stop or the hedging order and carefully move it upward until I'm able to keep stop at entry and fix the exit. So currently the high is 1.3375. So that will be my exit point. Hope you're able to understand that how these decisions are being made. And I'll give the remark what happened to that trade, whether it is filled or not. I'll just watch for about 30 minutes, 15 to 30 minutes. And in case if they are not filling it and market is not making even a small dip, I'll try to modify and take it around 33.43 or 44. When I see that they are not dipping at all, that means what? The players are not giving any chance for that of the short sellers. So they want to gain the levels and induce the short sellers to do the short covering. Then once they go above that of my buy position, 25 pips, I'll keep stop at entry and try to see whether they are trying to hit my stop or the limit order. So that definitely I'll be making profit out of that. Now in the case of GBP, they have quickly gained the levels because I want people to understand the concept very clearly. Even though I have been repeating it many times, I thought that I can give it step by step using new type of slides. That is why I taken more time in explaining it. So in that process, GBP came down to that of 59.82 and then gone up. So now GBP, it is trading around 1.6010 level. Also euro going up. So we'll watch and take it. Otherwise, if you understand that this is the way to trade, it's also fine. Now GBP has come to 1.6010 level, came down to that of the initial high, 1.5982, and made a little bit of downward stop and after 2 hours, and then started gaining above that of 59.82. So I'll try to keep 59.85. as the buy limit order. And an entry stop 30 pips below, that will be sell. $1.5955. So once it is filled, then I'll try to take it. Otherwise, I'll modify and try to take it at the market after 30 minutes of observation. And if you do it during the early part, when they are handling the majors effectively, you'll be able to really do a good trade. So let me just restrict it with these two, because not much time left out for reading the questions and answering to the questions. So I'll explain to you the fate and give the remarks here and review it during the part 2 of the webinar. Let me minimize the PowerPoint presentation and just focus the camera over that of the live market code page and try to answer to that of the questions. Sylvester, can you explain the previous? Sylvester, can you specify what slide? Because I just missed it reading your questions during the explanations. Yeah, I have given the market timings, new market timings now, Kanan. Yeah. Could you explain? It's again a bit confusing. Sylvester, can you just specify what you want? Cannot hear anything. If you lose audio, it doesn't. Okay. This 30 minutes has to be from start of the market. Yes, from start of the market, 30 minutes we watch and then try to take. Okay, now about GBP. Is this move with a push the pair higher or it will come down? See, they only make once the downward move and go up. And the second time if they make a downward move, they will continue to make a downward move. And that is referred as a pump and dump move. They try to hit the stops and come down. But normally when they make a gain, understand a person who has got a buy position, who failed to book profit during the first upward move, when they rise second time, you will definitely book profit. So there is no need for the players to drop it. Hope you are able to understand. Because only when the long holders are there, and suppose somebody has got a buy around 1.6050 or 33, do you think that 1.6033 somebody has bought will become afraid and try to liquidate it? Probably at 59.82 you would have liquidated it, but not now. So when they come closer to that of the high, the long holders are not in fear. Only the short sellers are in fear. When it has come to 59.82, technically traders would have thought that it will come down a little bit to that of the first support level before going upward. So such traders are now trapped. So the players are trying to gain the levels in the case of GBP and Euro, but still a small swing potency is always there because they have to swing the market, induce the traders to take more and more positions, only then they can trap. And such over trading traders having more positions beyond the reusable margin will only go in for stop loss. And if somebody is taking only one position and keeping about $10,000 is not going to be in a hurry to close the positions. Only those who become addicted to trading and try to take too many positions in too many currencies, they only become afraid of the market. Anything too many is not good in trading. So they are not expected to come down in the case of GBP. So it is very clear that they pretend as if they are going to do the extended move in the case of GBP coming closer to that of the initial high and then gone up. And Euro, they made the dip mainly to drop Euro GBP cross. Mainly to drop Euro GBP cross. That is why they just made the dip in the case of Euro. Now next dip we'll try to buy it. Then Edo. In the last 1 hour and 30 minutes of the session, if the low is not breached, one should buy. Yes, you can buy. If they are not breached from 30 minutes from the start of the session and they are holding it closer to low, definitely you can make a buy and try to keep stop at the entry. Are you not writing the blog nowadays? See, I'm really short of time, so I will try to write. It's not that I do not want to write and things like that. I have too many works to be completed. Yeah, it is being recorded, Alvin. Then spread. Initial high-low or the current high-low in the quote page. See, you have to make a note of the initial high and low, which is set around 3:30 GMT, and refer to that of the current high and low, so that you will be able to understand what sort of moves they are trying to do it, whether it is an extended upward move or whether it is an intentional up move. If it is an extended upward move, it will last only for 2 hours. If it is intentional upward move, it will last for 2 hours and start of the third session. So they have started during that of the European session, the gain above that of the initial high. So they are expected to gain till end of US session today. Because 2 sessions they have to do it. Then Sylvester. That is what the first slide. Never mind. Okay, you got it. Okay. Is USD CHF expected to drop more? They, as you see, the net change in the case of CHF is less when compared to Euro. The drop in the case of USD CHF is unlikely. They may not drop more. And Adam. How can we identify what they want to do in the Asian session? So one is you watch the Asian session where it is possible. Otherwise, don't strain yourself. You can make a note of it. And you just refer to that of the chart or any data feed where you are able to retrace the earlier data and find out whether the low or the high is breached. So if the low is breached, then you can see that the high is intact, and high you can note it down from that of the live market quote page. The low alone you try to find it from the chart and note down. And that may not be so accurate as a physical number, because in the chart, if you use 5 minutes chart, they try to average the 5 minutes of course and try to set it as a low. There might be a slight variations. And if you refer to that of the trading platform, you might find the local stop-ins in your trading platform that might be different from that of the live market quote page. Adam, can we identify gap time between weeks? Yeah, obviously you come across the gap time. That is the gap time after the Friday close and the start of the Japanese session on Monday. So, but the market is closed on Saturday and Sunday. And about 4-5 years back, probably some of the traders might have noticed that they used to refer to that of the pending orders in the market. So Saturday and Sunday also, the live market quote page used to make a lot of moves, and they try to extreme moves like 300 pips, 500 pips and things like that to see where the stops are. But nowadays, that sort of moves are not happening because the volume has come down drastically. See, these are all the tricks which are being deployed to trap the traders. Then Jason, are you expecting Euro coming down to that of 32.95? No, I'm not expecting Euro to come down so drastically. They are expected to gain the levels because after making an upward stop, and normally they are supposed to come to that of the middle level as a 50% retracement, and afterwards up to that of the low as a false move. or breach the low as a stop end before making upward move, because during the upward stop end, many of the long holders might just book profit. So not much of a downward move is required in order to induce the long holders to liquidate. Without a gain, if they drop, only then the long holders come in plenty to liquidate their long positions. Then Shan. Euro dollar, any change of its crossing 1.34? Yeah, euro is expected to rise above that. GBP is also expected to go above 60.50 today. Then intentional moves happen in second and third weeks mostly. No, on a daily basis, they alternate the intentional move with that of the extended moves. So, as you know that extended move is only for 2 hours. A session is around 7 hours. So, intentional move is part of the game. So, they alternate extended move with the intentional move, and in between they make stop-ins and the false moves, and also swings where the volume is less during mid sessions. So that is what you have to identify. Then Alvin, where can I get to view this recorded? Yeah, the recorded webinar is available in FX Street Archives, and there you can definitely look into that. And you just go to that webinar in the header menu, and once you click webinars, you will find the list of people, experts giving the webinars, and adjacent to that you find archives. You just click archives, you will find all the recorded webinars are being listed. And see, the main purpose of recording the webinar is for those who are not able to attend the webinar when the time was chosen, and they might be busy with their work and things like that, they can listen to it later on. And if you hesitate to listen to it and you want only a fresh webinar and ask questions which are being already asked and answered in the previous webinars, then you can really shorten your the time you consume to understand the market by referring to that of the archives. There are so many experts given so many ideas pertaining to the market, and that will also make you to think what could be your own trading strategy. And new market timings, I have given the market timings which is shown. I'll show it again. Again, part 2 of the webinar, I'll just present the same slides with slight modifications, and you can get the timings there itself. Desktop and high, the market will go opposite to low, not necessarily. They make an upward stop and then come down to that of the middle level if it is a positive net change. When it is a negative net change, then they make a stop and come down to that of the low or below the low. So the net change also helps us. See, all I cannot just explain in 45 minutes, you should be able to understand. Let me just show you the run up the slides very quickly. So these are all the market timings: Japanese session, European session, and US session. Then this is what tracking, how exactly in 3:30 GMT you can make a note of the note from the live market quote page and try to identify the type of moves. The type of moves, stop and the false move happen in less than 30 minutes, extended move up to 2 hours, and more than 2 hours is the intentional move. You can use it any name. These are all the names I have given it, and you can just give any name for that and ultimately understand. In case if it is hedged, how exactly the hedging is helping us to take decisions in a market to limit the risk and maximize the profit, and also you are able to really think of limiting the risk to start with, and once you are out of market fear, then you think of maximizing the profit, because many of the traders, when they take the position, when the position is making loss for a prolonged period, when they come to positive territory, they simply close it with 5% profit. They are all act of fear. So you should be able to get rid of that. Then when hedged, you just note down, watch for 10 to 30 minutes and handle the hedging. If it is making loss, close it and keep another hedging order and trail it. If it is making loss profit, Then keep stop at entry, wait for the market to go down anywhere and come up upwards after a day or two. Then you continue the trading on the upside. That is possible. And just to leave the trade and take another sell and buy trade if you want. These are all your own ideas. You have to think of it. So I have kept a buy limit order that has not been filled. It has gone to 33.50. I will not chase the market. Any dip, I will try to take the buy. Otherwise, I'll just wait for the next session to take the positions. So I'll present part 2 of Tracking the Forex Market Together webinar between 13 and 13:45 GMT. During that time, I'll review the market again and also explain to you how during the gap time before the start of the Europe-US session, one can one can make quick trades for less than 30 minutes. And gap time moves a false move. In case if they make a dip, you buy, and within 15-20 minutes of the session, you'll be able to book profit. In case if the gap time they gain the levels, they are expected to drop during first 30 minutes of the session. And then you can do a sell and buy trade and quickly book profit. And that sort of gap time trade I'll explain to you. And also we'll refer to that of the high, low and the net change. Compare it to that of the initial low and the high to understand where they are taking the market. Then after reviewing the earlier trades, still I have not taken the trade. I kept only a limit orders. In case if the orders are filled or I have modified and taken the positions, I'll explain to you how exactly I handle the position. In case if it is hedged, how exactly I handled it, I'll explain to you so that you'll be able to get rid of the market fear when you use the hedging and try to maximize the profit by using a trailing stop. So I'll come back by 13 GMT. See you again by that time. Thank you one and all. Thank you, FX Trade.